So I sent out your 10 commandments, Mohnish, the other day, your 10 investment commandments. One of the ones that someone pointed out was, I don't remember, I think it was maybe 5 or 6, where it was, thou shalt not use Excel. At William & Mary, that's a bit of heresy. Please explain, what is your philosophy behind that?
I think in investing, you should be able to do the math in your head. And if you need to have a complex Excel DCF model to tell you that something is a good investment, it is not a good investment. So I'll give you maybe some extreme examples. But there's in 2019, I made an investment in this company in Turkey, Resas Logistics. And this was a $20 million market cap at the time, and the liquidation value was like 800 million or so. And I was visiting them because a good friend of mine in Turkey, who's a very strong kind of Graham type investor, I just told him I want to visit all the businesses that you already invested in. Kind of one layer of diligence already done because someone really smart has filtered through. So I asked him, is it a fraud? What's going on here? And he said, no, I have an investment and the company just doesn't have great IR or anything. And they had a bunch of warehouses. It was very easy to value those warehouses. They were in very prime areas, 99% leased, 10-year inflation index leases to like Amazon, IKEA, Carrefour, DuPont, Mercedes, and so on. And so there's very strong recurring revenue business. And then you could just you could in 6 months liquidate the whole portfolio and have about 800 million or 700 million or 900 million, something like that. And you were paying 20 million for it. And there's no Excel needed. And now the business, in the last 3 years, the Turkish lira has been decimated. And I invested at that $20 million market cap. It was 5 lira to the dollar. It is now 18.5 lira to the dollar. So very strong depreciation of the lira. In dollar terms, we are up about 9x in the last 3 years. And so the company now has a value of about 180 million or so. And the liquidation value, they've actually improved. They've done a bunch of things which have improved the business. It's over $1 billion. They actually depressed. It could be in normal times $1.5 billion or 2 billion. So we're still sitting at something like 10% or 20% of liquidation value. So you don't need Excel for that. And one time I was in 2006, I was looking at a steel manufacturer, IPSCO. And IPSCO was a situation where they made tubular steel, what goes into pipelines. And they used to get these long-term contracts because some pipeline will take 2 or 3 years to get built. So they want to have assurances of the steel supply and so on. And so IPSCO had about $15 a share in cash on their balance sheet. They had no debt. And they had publicly stated that the next 2 years, their earnings were going to be $15 a share each year. So the stock was at around 45. And between the cash and the next 2 years that the company is saying they would make, and this wasn't like normal guidance, they have contracts with these pipeline guys to build these pipelines. So it's not like Apple's making some forecast or something. This is actually hard-coded. And after 2 years, because it's a cyclical business, earnings could go to zero. It could even go negative. So my take was, if we just hold the stock for 2 years, we'll have $45 of cash in the business, and plus all the plant and inventory and everything else. I just want to see what the market values it at that point. I just want to see how Mr. Market's going to price that business. And about a year later, maybe 8 or 9 months later, they announced that they're going to have 1 more year of earnings of $15 a share. They got some more contracts. So now we were in the money. We were going to be at $60 guaranteed. And the stock had now moved up to mid to high 60. Mr. Market was recognizing some of that. And I was looking at it and I was thinking, what should we do? And it had gradually then over the next few months moved up to close to $90 a share. So within about 18 months, we had a double. And I was thinking, this is a good deal. It's a cyclical business. I think we should exit. And as I was running through that math in my head, I woke up one morning and some Swedish company had made an offer to buy them out at $160 a share. And the stock had immediately gone to 152 or something. And I didn't even wait for understanding the odds or whether that would happen or not or what. I sold all the stock because I was almost ready to sell at 90 and I'm getting 150. And I don't know what these Swedish people are doing 2 years back when you could have bought it for 45 or maybe paid 65 or 70 or something. That's the way the world works. So I think the best way to invest is to, first of all, you make very few bets. You look for extremely asymmetric odds where you just know that statistically it might work for you. Now, even when you do all that, you may still have a 30-40% error rate. But that's okay. It doesn't matter because the winners are so heavily doing so well that the losers don't matter. So I think that basically the using Excel is actually a red flag. It should give you a red flag when you are reaching for Excel because you shouldn't need it. You shouldn't need it to figure out if I'm looking at something like Micron, I don't need Excel. I can look at their sales, I can look at CapEx, I can look at their cash flows, and I can look at where the industry might be in a few years in terms of sales and cash flows and margins and so on. And you can run the math in your head. It's not that hard.